Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 1 of private placements: what they are, how they work, and why they matter. Raising money is a challenge every company faces, and not all funding methods fit every business. Private placements offer a flexible way for companies to secure capital from select investors without going through public markets. This approach isn't just about raising funds, it can also provide businesses with strategic partnerships while giving investors exclusive opportunities. Whether you're a growing startup or an established business, private placements might be the key to unlocking your next phase of growth. What is a private placement? Private placements are a lesser-known but powerful way for companies to raise capital. Instead of turning to public markets, businesses offer securities directly to a smaller, select group of investors. It's a tailored approach that prioritizes flexibility and exclusivity, making it an attractive option for certain companies and investors. Definition and characteristics. A private placement is the sale of stocks, bonds, or other securities to a limited group of investors. These investors might include institutions, accredited individuals, or even close business partners. What sets private placements apart is their exclusivity. Companies don't open these offerings to the general public. Key characteristics of private placements: limited participants. Only a small pool of investors is involved, often chosen for their financial stability or strategic value. Exempt from public filing. Unlike public offerings, private placements don't require registration with the Securities and Exchange Commission, SEC, saving time and cost. Types of securities available. Companies can offer equity, like shares of stock, debt, such as bonds, or hybrid instruments like convertible securities. This process is highly customizable. Whether a company needs immediate cash flow or long-term partnership opportunities, private placements can be structured to meet those goals. But this flexibility comes with trade-offs, including limited liquidity for investors. Differences from public offerings. At first glance, private placements and public offerings might seem similar. They both help businesses raise money. But dig deeper, and you'll see key differences. Regulations. Public offerings must meet strict SEC regulations and file detailed documentation, such as a prospectus. Private placements are exempt from these requirements under Regulation D, making them faster and less expensive. Investor access. Public offerings are open to anyone with the funds to invest. In contrast, private placements usually target institutional investors, high net worth individuals, or those meeting specific qualifications. This exclusivity can limit who can participate but often strengthens investor relationships. Transparency. Public companies must share financial and operational details openly. Private placements don't have the same disclosure obligations, allowing businesses to keep sensitive information private. Liquidity. Publicly traded securities can be sold on stock exchanges, making them highly liquid. Securities from private placements are often harder to sell until specific conditions are met. By skipping the hurdles of public offerings, private placements offer companies a shortcut to funding. At the same time, they provide investors with unique opportunities. But these benefits come with a trade-off: less oversight and a smaller pool of participants. Types of private placements. Private placements come in different forms, depending on a company's goals and the needs of investors. Whether it involves selling equity, issuing debt, or offering hybrid options like convertible securities, each approach serves a unique purpose. Let's explore the most common types and what they mean for businesses and investors. Equity private placements. Examine private equity placements and their impact on company ownership. Equity private placements involve selling ownership stakes in a company directly to private investors. These stakes often take the form of shares or stock, giving investors a piece of the business. For startup and growing companies, this is a popular way to raise capital without taking on debt. However, giving up equity also means sharing control. Investors who acquire large stakes may gain decision-making power, including influence over operations and strategy. This shift in ownership can be a double-edged sword. While it attracts much-needed funding, businesses must consider the long-term implications of diluted control. Equity placements are often attractive to high net worth individuals and venture capital firms. Why? Investors aren't just financing, they're buying into the company's future success. For them, equity is a high risk, high reward opportunity, especially if the company scales or goes public later. Debt private placements. Discuss private debt placements, including bonds and loans. Debt private placements are an alternative to equity. Instead of selling ownership, companies raise money by borrowing funds. These funds typically come in the form of private loans or bonds, which they agree to repay over time with interest. This option is ideal for companies that want capital without giving up control. By taking on debt, businesses maintain full ownership, as lenders do not acquire stakes in the company. However, this comes with obligations. The company must ensure it can meet repayment terms or risk legal and financial repercussions. Debt placements tend to appeal to institutional investors such as insurance companies or pension funds. These entities value the predictable returns that debt securities often provide. For businesses, it's a straightforward way to secure funds while preserving independence. Convertible securities in private placements. Explain convertible securities and their use in private placements. Convertible securities are a hybrid approach. These instruments, commonly convertible bonds or notes, start as debt but can be converted into equity under certain conditions. Essentially, they offer the best of both worlds. Lenders earn steady interest like traditional debt but also gain the potential upside of equity. This makes convertible securities a flexible option for companies seeking funding. Early-stage companies, in particular, favor this route. Why? It allows them to offer short-term debt while postponing equity dilution until a later point, such as a significant valuation increase or financing round. For investors, convertibles provide security with upside potential. If the company performs well, creditors can convert their investment into shares and benefit from its growth. If things don't go as planned, they still have the fallback of receiving the original debt and interest. This blend of debt and equity makes convertible securities an appealing choice in private placements, giving both sides room to benefit. Benefits of private placements. Private placements offer distinct advantages for businesses and investors. They provide access to funding without the lengthy process of public offerings while creating opportunities for strategic partnerships. Here's a closer look at some key benefits. Access to capital. Raising capital is often urgent, and private placements can help companies secure funds quickly. Unlike the drawn-out timelines of public offerings, private placements streamline the process by limiting the number of investors and bypassing extensive regulatory steps. Why does this matter? Time is critical when businesses need to expand operations, launch new products, or cover unexpected expenses. A private placement allows companies to avoid delays. There's no need for lengthy SEC approvals or public filings. Speed up funding. Agreements can often be finalized in weeks, not months. Tailor investor terms. Businesses can negotiate flexible terms, aligning with their needs and priorities. For businesses, this means faster access to the resources they need to grow without being tied up in red tape. Less regulatory burden. Public offerings come with significant regulatory demands, from SEC filings to public disclosures. These requirements can be costly and time-consuming for companies, especially those with smaller teams or limited budgets. Private placements, on the other hand, are exempt from many of these rules under Regulation D. By opting for a private placement, companies can lower costs, avoid the high fees tied to preparing IPO filings and continuous reporting. Maintain privacy. Sensitive business information remains confidential, protecting competitive advantages. Simplify compliance. Fewer regulatory hurdles mean more focus on raising money and running the business. This streamlined process isn't just easier, it's a smarter path for companies looking to grow without exhausting resources on compliance. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.